Lesson 1. Technical Analysis. Making technical analysis. Let's talk about it in detail. The first moment to cover is the period of making technical analysis. People often ask what period they should take to make smart technical analysis. Everything that's in the chart, whether it refers to 1995 or 2002 or 2006, is equally interesting for the market. Every peak, every bottom, every price movement formed during that time will be reflected in future. The technical analysis is based on one simple rule. History repeats itself. All the information contained in prices in history will definitely be reflected in future. So speaking of the periods, ideally we should consider everything that's happened from the very start of the market, from mid-70s. But in real terms, there is no need for such extremes. Now let's talk about specific periods used in particular cases. The crucial thing is to get prepared, to choose the right graphic chart and its right size. Let's talk about the line chart. It's not really suitable for making the technical analysis. Why? The line chart does not contain any information on the minimum and maximum prices, so it doesn't give a complete picture of their formation period. Let's have a look at this peak. Everything is shown in closing prices. We see the price 1.3767. If we switch to the candlesticks, we'll see that the prices were actually higher, reaching the level of 1.3782. And the line chart doesn't give us that information. So due to its low informativeness, we should not use the line chart at all. The lack of information would lead to an inexpert technical analysis, mistakes and inaccuracies which would cause losses in the end. Let's compare the bars and the candlesticks. They both are optimal graphic charts. But which is better? The candlesticks, obviously. They clearly show the instances of price drops and rises. In the bars, it's all mixed together. We choose candlesticks and we see everything clearly. The black ones going up, the white ones going down. That's why I strongly recommend candlesticks for the technical analysis and for the market observation in general. Before we start making an analysis, let's mention a few moments. What period should we take? The technical analysis is made and used on periods no shorter than 1 hour. A 1-hour chart is the minimum period for technical analysis. If we choose 5 minutes, we'll see a lot of breaks and lack of prices at specific moments. It would be very difficult to build up a technical analysis using this chart. Another important moment. I don't know any trader using 1 minute, 5 minutes, 15 minutes or 30 minutes charts. 1 hour is the minimal period. That's what we need to start with. Some more about the periods and the build-up. All charts have the same pattern, whether they are 1 hour, 4 hours, daily or weekly. They are built in the same way. How? The most important preparatory moments. First, the size. You can choose this size for your candlesticks or you can make them very big. Which is better? This one. Why? The information we see on the screen is quite enough. There is no need to shift the chart further into history. What we see is enough, but under the sole condition, the size should be right. We set it like this. If we zoom out, we can't see the candlesticks, and in that case, we won't be able to see the closing prices. All the lines are drawn based on the closing prices, which are the crucial information in the technical analysis. They let us see whether it's a false or a real break, and that is very important for future price forecast. So, this size is not suitable. Let's zoom it in. The next size is optimal. Talking about sizes, I can mention a mistake typical for new traders. They make charts even bigger as the candlesticks are seen better this way. Please note that size allows us to see the information on the screen starting only from July the 13th. If we zoom it out, we can see everything from July the 6th, which is twice as much. That's the recommended size. And our technical analysis will be more accurate and correct. So we've chosen the size. Next, always remove chart shift so the effective price is shown on the edge of the screen. No lines are drawn through the effective price anyway. All the lines are drawn through the peaks and bottoms. You must not draw your lines through the effective price. It is not interesting for us at the moment at all. After you've done your preparatory work and set the charts, the next job is to use the diagonal trend lines to connect all the mentioned peaks and bottoms. Those peaks and bottoms that any market player would see on this chart. You do it using the closing prices. The closing price is always on the peak, ascending. So, we'll draw our line from here. Let's do it. Let's connect those peaks. The more lines we draw, the better. We'll end up with a complicated cobweb, but don't be scared. We'll untangle it slowly. Let's connect the bottoms. There are quite a few of them here. It's better to do it from this point, from a candlestick. A point either way will also show in the inaccuracy. You should try and draw them as accurate as you can. There are enough problems with inaccuracies anyway. Let's not make them worse. Now we connect those peaks. Please note, if the peaks are connected by closing prices, the line would act as a good support. This is shown by the big numbers of bottoms. We'll talk about it later. Looks like we've connected all the other peaks and bottoms, and we've got this rather unclear picture. How do you see a price channel here or a shape? Let's now move to that. What do we need to do next? We need to look at each of those lines. I've missed one here. Let's draw another one. It goes through this bottom. We should try and connect all the major peaks and bottoms on the chart. Each line should be analyzed and decided whether they are strong and interesting for the market or not. How is the line's strength defined? By two key moments. One is the slope angle. The bigger the angle, the shorter the line. Or, in simple terms, weaker. A strong movement cannot be long-term. Let's have a look at the line here, for example. There is a bottom, there is another one, but it was broken, of course. The market cannot be going up that quickly for a long time. The line is short-term. A giant angle. All the lines with a 60-degree angle are short-term and weak. There are no such lines on this chart, so let's talk about another feature that defines the strengths. The number of rebounds. This is the most important factor. The more rebounds, the stronger the line. Lines with 3 rebounds are considered to be strong. You can and should use them in your trading later. If a line has only 2 rebounds, it's still rather weak and hasn't proved itself yet. We don't know if the market players would consider it worthy for opening deals yet, so we shouldn't use those lines for trade. We should just mark them for future use. For a line to get 3, 4 or more rebounds, it should have at least 2 for a start. We won't delete it yet. Let's see how it performs in future. So, which of all these lines are strong or weak? Let's start from the top. This is an ascending line. 1 rebound, another one, the third and the fourth. It's a rather strong line. It worked 4 times. It was used 4 times for trade. So it will be done again. Let's change its color and make it blue. For a better visualization, we'll make it red and thick. It's a strong line. We can work from it in future. Another ascending line. One rebound, another, the third. A good strong line. We'll make it thick as well. We'll also use it for trade. One rebound, another, the third, the fourth. It was broken, and again, and again. Please note, at the beginning the line was working well, but then the market stopped considering it and started breaking. Here, there. So it is of no interest to us. It's not effective. We remove it. 1, 2, 3, 4, 5 rebounds, whole 5 of them. Look at this movement here, at this shadow. People often ask whether it's considered to be a rebound. Of course, it is. A rebound means that the price came close and gave a rebound. Was the price here? It was. The shadow shows that there were prices in this area. 5 rebounds from the line. We'll leave it. It's a very good line and can be used for trade in future. The next line. 1 rebound, another and another one. We have 3 breaks here. Lines can be broken and give rebounds after that. If there is a real break of a resistance line, and it was working as a resistance line, and was broken, it should change its status and act as a support line. For some reason, the line doesn't do that. So, it's broken again. If it is broken, if the line really works, if it's good and effective, it should give a rebound and act as resistance. But it doesn't do that. 3 times in a row, without the status change, the line was broken both ways. It shows that the market stopped noticing it, stopped respecting. We remove it. Even the future rebounds don't count in favor for this line. 3 breaks in a row is not too good. We don't need suspect lines, it's better to get rid of them. We'll leave only strong lines that really guarantee market rebounds. Another ascending line. 1 rebound, another, 2 rebounds. We can't say it's a bad line, rather it's not a good one yet, so we'll color it yellow and leave it thin. It will be for information. In future, if a price comes close to it and rebounds, the line will become strong and we'll be able to use it. Another line. We see some sort of a break here. The closing prices are higher. We can correct it according to the closing time at the last peak. Now we see 1 rebound, 2 and 3. There is something interesting here in the middle. People often ask, is it considered to be a rebound? It looks as if there was a couple of points lacking, but let's remember the inaccuracies present in any chart at any period. For 1 hour chart, a 5-7 point inaccuracy is quite normal, and instances with 1 point lacking are considered to be touches. Even if there are 2, 3, 5 points to the line, it's still considered a touch. So we can safely say there was a touch. It's a good line. Let's make it thicker, and we have another strong line. What else have we got left? 2 ascending lines. 1 rebound, another. Looks like the market respected it and gave it a small rebound. It was broken. After a real break, a line changed its status and became a resistance line. And here is the proof. The market returns to it and traders open sell deals from it. But later we can see that the closing prices were higher, so the line was broken again, here and here. And now the effective price is right on it. It was broken 2 times in a row. It doesn't change its status anymore. The market simply stops seeing it. So we remove it. 1 rebound, another. What can we say about this line? We can't call it weak or strong, it just hasn't been formed yet properly. So we'll make it yellow. So what have we got here? Rather an interesting picture. First, let's talk about the price channels and patterns. We can't see any patterns. They are just not here. But a price channel starts appearing. There is a resistance line above the effective price and a support line below it. What conclusion can we make? Let's have a closer look at the chart. We shouldn't do anything at the moment. Neither buy nor sell because no line is touched. All the red lines above the effective price are the resistance levels. Everything below it is support lines. And since we can't do anything at the moment, let's make a trading plan for the future. We know that if a price approaches a resistance line, there will be a rebound. That means we should be selling from there. So we can write down in our trade plan, open a sell deal at the price 1.3832 to 33. Give or take a few points. And pay attention to the following fact here. All the next levels should be used as stop calculation levels. These are the levels for hiding the stop-loss orders. Why? We know that resistance lines can be broken. So what can happen then? If a resistance line is broken at the level 1.3833, what can stop the growth of the euro-dollar currency pair, the next resistance level? Those market players who haven't been trading yet would use it to open sell deals. That's why we plan to open a sell deal at the price 1.3833, and the stop loss in this case would be set behind the next resistance level. If we look diagonally at the angle of 45-50 degrees, the price would be going up. It goes up and reaches this point. In case of a break, the next sell zone would be approximately at 1.3860. Please note, for a 1-hour chart, you should put stop loss at least 15-20 points higher behind the next level. Why? Because of the inaccuracies and the price noise. So we add another 20 points to our level and we get 1.3880. That would be a smart stop loss, quite difficult for the price to reach. Its movement is restricted by this red ascending line for a start. Then there is the next resistance, so it would be very problematic for the price to reach the level 1.3880. The stop loss is well hidden. Now we should think about our take profit. It is set in the following way. It should be fully open to the price fluctuations. But there is one tricky moment here. The support line that should stop a fall in this red line at the price level about 1.3765. We place the take profit a bit higher to avoid the situation when we were 1 or 2 points short and the take profit didn't strip, not to go back and lose profits. So we place our target a little lower. Let's go back to that hidden danger. This is that ascending line. We didn't mark and leave it for no reason. There are market players who don't want to wait for a long time. They are not demanding and are just interested in a quick profit. They would close at that level, at the nearest support level, because they can see it. So there are two profit-taking zones. One, the nearest, 1.3802, give or take, and the other zone, 1.3770. It's a bigger target, but you would have to wait longer to reach it. The yellow line becomes the dividing line, and there everyone should decide for themselves. Someone to get less but quickly, and the guarantee is higher. Please note, the yellow support line could give a rebound in future, and the price would go up. And now, I will mention an interesting moment about the support and resistance lines. Any strong line with a minimum of 3 rebounds should give at least another one in future. If the line is rather weak, like this yellow one, it can also give a small rebound before a break for the same 5 to 10 points. And then it would be broken to reach the second target. But that would take much longer. Let's summarize. The buy zone 1.3833, a smart stop loss 1.3880, never closer. The stop loss is about 50 points, 47 to be more precise. Profit-taking zone, the nearest for those who don't want to wait, 1.3802 to 1.3805, give or take. The take profit is not big, about 25 points. Now, for those who are prepared to wait, if we use the lines and the price channels correctly, we should get to the support eventually anyway. The yellow line is not strong yet, so the next profit-taking level is 1.3770. In this case, it would provide the profit of about 60 to 65 points. So we get decent commensurable stop loss and take profit figures. Stop 47 points, profit about 63. You can enter this specific deal. The correlation is good. You can safely open for sale. Those who plan to close at 1.3802 to 05 with a 20 to 25 point profit should perhaps refrain from this operation altogether, as the stop loss would be twice as big. And this is not quite right. You should forego such deals. It's better to have the estimated take profit levels higher than the stops, so that the estimated profits exceed the maximum allowed losses. That would be more adequate and reasonable from the assets management and distribution of risks point of view. Let's go back to our technical analysis. In this situation, we can put down the specific prices and wait until the effective price reaches the resistance line, touches it, and then we can open a deal. Now all we can do is wait. Let's look at this picture from the buying point of view. I believe most things are clear. We covered them while calculating our stops and profits. The nearest buy zone starts at this red level. We'll never use the yellow one, it's not strong yet. If it gives a rebound, we'll consider it as a potential buy zone. But the nearest zone is level 1.3762. It would be touched approximately at this price, 1.3762, and we can safely buy. So, let's make a note, 1.3762, buy. Where shall we put stop loss and take profit? As we mentioned before, stop loss should be hidden behind the next support level. But we can't see the next support level here at all. What should we do in this situation? We take a horizontal line and check the closest bottoms, the minimal prices reached by the market, 1.3751. It tells you that this level, 1.3751, can easily be reached again. It's happened before. It could happen again. So we put the minimal price behind this level. We set stop loss at 20 points below, 1.3731, 1.3730. That's where our stop will be. Take profit. Where shall we place it? When it reaches this level, the yellow line will be broken. It won't be of any interest then, so nobody would regard it as a potential profit-taking zone. How and when will it happen? They would go down, and after a certain time would go up. You can imagine it approximately. So the profit-taking zone would be before a resistance line. This is the zone for taking profit. Between both lines intercross in this area. The profit-taking zone will be about 1.3830, give or take. Leaving a tip for the market, we can make it 1.3820. Rather a good result, too. Stop loss is hidden behind those bottoms. The minimum prices could always tell you how far the shadows could reach, so the stop is well hidden at 20 points below the minimum prices, with an allowance for the noises. Take profit is set before an important resistance line. A deal opens on a good support line that has 5 rebounds already, or even 6, if you consider this local bottom. Let's make a note of the buy zone in our plan. Then we have to wait. Using those guidelines, having analyzed correctly all the lines, we get a general picture of what needs to be done. We've defined a good resistance zone and made a note. We'll buy from there. We've put a stop loss behind the next resistance level, defined a buy zone on the basis of the nearest strong supports, hidden stop loss behind it, and now all we can do is wait for the touch. Open deals, set stop loss and take profit, and then the computer and the market would confirm or contradict our forecasts. So, this is pattern for making the technical analysis. Choose the optimal graphic chart, the candlesticks. Choose the correct chart size. Connect all the peaks and bottoms in the chart. Define and mark the strong levels. Make up a trading plan by defining the buy and sell zones. Lesson 1. Technical Analysis. True break. A true break of a price channel usually follows one scenario. Let's take a look at how it happens on the pound versus dollar currency pair on the hour chart. There is an uptrend formed by levels of resistance and support. The movement is formed which leads to a true breakdown of the support. There were only few deviations from the line and the support is broken. The true break opens a way to new horizons, in this case to the downward movement. The market corrects itself. There is a throwback. Why does it go back? In case of a strong downtrend, the participants start thinking about fixing positions. The traders who are not as greedy as the inexperienced ones know that greed is one of the worst issues in the trading, so they start fixing their profit on time. What is the outcome? The prices start correcting and going back. This return to the broken line that is already acting as a resistance indicates the true break. The status of the level is different. The line is positioned as a resistance now. The price goes back, it touches the line, the participants start selling. The persistent downtrend movement starts from here. In this situation, our immediate goal should be on the level of the first downfall after the break. In most cases, they go much further. For those who are not too greedy and not trying to get all the money in the world, I would recommend placing their take profit at this first downfall level. This goal will be reached quite quickly. A fair profit for a short period of time. We won't be holding the same positions for a day or two. We won't be worried if our profit grows or comes to nothing. We are now looking at a classical example of the price behavior in case of a true break. Unfortunately, some people, even knowing about it, manage to lose a lot of money. Why? That's because they enter market at the first wave, when the first impulse comes after the true break. Now, we are going to zoom in and take a closer look. They open up when in motion, thinking that the price will go down dramatically and they will be able to earn a lot. They don't want to wait for the price to return to the broken level and hope for an immediate collapse. Unfortunately, that rarely happens. In most cases, it doesn't happen at all. Experienced participants who opened at the break based on news, political developments or adjacent markets start fixing profits. They close positions ipso facto, correcting the prices to the resistance level. In case of a true break, you shouldn't try jumping on the sailed ship, but you should wait for the right entry point. This will be the point where the price touches the resistance level. Any deal in the technical analysis is opened only on touch of the level. If there is no level here, there should be no trade according to this rule. If we follow this rule, we won't have those problems. What else can we do in this situation? We opened a position. Expecting a dramatic downfall, we don't fix a profit but decide to wait. That's fine. The price will be back and it will touch the resistance line. There will be a rebound and bottoms anyway. Please note that we are spending a lot of time in the loss zone. We're concerned if it goes any further. Another important thing is that the sell position is opened at unfavorable prices. If we wait,
for the touch of the resistance line, the position opens at best price. Therefore, we get the maximum profit in such a situation. There are other pitfalls, especially for beginners. They say if you want to find out where the bottom price is, ask a beginner where they sold it. They do love to open positions while trying to chase the ship that has sailed. I strongly recommend that you look at this situation one more time. We're looking at a classical scenario of a true break. If a true break of a price channel happens, nothing should be done. All the experienced traders who know this technique will keep waiting for the price to return to the broken level. Then they'll start selling from here. There's a 90% chance of this return, as if the price comes back to the broken line to say goodbyes. Better prices are given in order to have more participants enter. You can't make experienced traders sell at this point. Only beginners try to catch the ship that is already sailing away to earn a little money. As a result, they can't get a good profits because they wait for too long. Their greed starts pressuring them. They have no well-defined goals. That's why you should try to avoid such situations. Having a true break, wait for the return to the resistance level, and only then start selling. Your first goal is the level of the nearest lowest point. The next levels are defined by a full technical analysis, but the minimum is reached almost always. Notes: there is no better entry point than a touch point of a strong level of resistance or support. There is a 90% chance of this price to return to its broken level after a true break.
Lesson 1. Technical Analysis. There is an event scary for all the new traders and causing no emotions among the professionals. Event known as the real break. Many believe, and there is an element of truth in it, that if we open a position within a price channel and a real break takes place, that would cause losses. That's not the compulsory scenario. Let's talk about the break itself. There is a signal that can give you a hint and warn about the possibility of a break. And it would tell you that you must not open a rebound-based deal. Let's take an example. Euro-dollar, a 4-hour chart. Here you have a classic price channel, the resistance line, the support line. Let's consider the following situation. When the price was getting to the resistance in the area of 1.3045, we would open a sell position. The ultimate goal would be set according to the price channel height. We set the take profit level before the support line in the area of 1.2930 to 1.2940. What do we see next? The movement went in the forecast direction but never reached the line. The cycle was not completed. What would that underreach tell us about? That our colleagues, the sellers, got out of breath. You start selling from the support line and the line turned here. The market players started taking profit at the level 1.2950, give or take. Those who were selling from the resistance started closing their positions. Some of the buyers would open as well. The line was not reached. The cycle was not completed. If we had a rebound of the support, we should reach the resistance. Rebound off the resistance should reach the support. The cycle was not completed. It means the sellers got out of puff and could not bring the prices to the support. That leads to the following conclusion. If the sellers get out of puff, the buyers won't. And that would cause the movement to go back to the resistance line followed by its break. If one of the lines was not touched, then the opposite level is likely to get broken. That's why we should never open a bounce sell deal in this situation. Let's go back to our example where we opened a position. We have not reached the take profit. If we keep checking our positions and our deals, see what they do, then we'll be able to modify the orders after reaching certain levels. Suppose we opened at 1.3038. The take profit was set at 1.2929. Let's look at the market at the point when the price started going back. First, we can close the position and take a profit, although small. We haven't reached the ultimate goal yet, but if we have a significant profit, we can leave the market. You don't have to wait for the maximum if you have a secured profit, in this case of about 70 points. Second, we can set the stop loss at a loss-free level or in the profit-taking zone. By doing this, we'll follow the classic rule: no closing deals in the middle of a price channel. The goal set being set, we should reach it. But for some reason, it doesn't happen in the given situation. Well, there is a chance of that too. But in any case, the immediate goal has been reached. The position would close either with the minimum losses or on zero. We are not losing anything. It is not quite right to call the break the most awful event in the price channel. First, the break gives us new opportunities to enter the market. Second, you can forecast a break. If we spot such an underreach of about 1/3 of the price channel, we simply wouldn't open. And in this situation, a break would not cause us any losses at all. Speaking of the breaks, there is another important moment. There is normally a return to the broken lines, which gives us a chance to open a position. Let's have a look at the Euro-Dollar daily chart. We can draw a resistance line through the peaks and the support line through the bottoms. Support, resistance. We have a price channel that is left later. In case of a real break, a candlestick would close at the higher level. A daily chart. Later, after a certain time, the price will go back to this support line. Even if we were selling from the resistance, the deal was closed by the stop loss level, causing losses of 100 to 200 points. It's a daily chart, so the size is quite big. The deal was closed with a loss. Not to worry. We'll wait for the price to go back to the break line. There was a resistance line, a real break, so the line changes its status. The price comes back. We can safely open a buy position. Then there is a rebound, and we take a considerable profit. Let's remember how we set our goals in similar situations. We open a sell position. What goal shall we set? It is defined by the technical analysis, by the peaks and bottoms formed after the price channel break. The textbook scenario implies the goal set on a horizontal level starting from the first framed top, 1.3341. So we set the goal at this peak and wait until it's reached. We see that the goal has been reached. We even covered the losses caused by the real break of the price channel, so it would be wrong to see the break as the most terrible losses-causing event, although there is an element of truth in that. But the main idea is the following. After a break, the line would receive smart buy or sell signals if the situation turns the other way round and the price channel is broken to the south. Let me remind you that this return to a broken line happens in 90 cases out of 100. In most cases, the market would give you a brilliant opportunity to open a good position. As it was mentioned earlier, the prices go back to the line to say their goodbyes before sailing for some new horizons. But don't get too greedy, especially if it is a long period chart like a daily chart. We set our first profit-taking level, which in this case was 445 points. We should have waited for a few days, of course, but these situations can be test run on 4-hour and 1-hour charts as well. Similar scenarios take place much quicker there, but they bring much less profit. A real break. The status change providing good entry points in future. Lesson 1. Technical analysis. Let's consider several occasions where it can be clearly seen how price channels and trend lines work on a currency pair of dollar and franc on a 4-hour chart, and also how the market respects these lines after a true break, especially after several true breaks. On different sides, when the line changes its status. Here's a price channel. The support line is based on the tops. Accordingly, the resistance line is based on the bottoms. Here's one rebound, the second rebound, the third one, the fourth one. The levels of support and resistance are formed after the 4 rebounds. We open a sell from the resistance and wait for the touch of the support. After that, we take our profit. Then the market rebounds to the middle of the price channel and returns to the support level. After that, it breaks the line. A true break is obvious here. Note how the market deals with the broken line. The participants start selling because the line changed its status and became resistance. After the sell, the market starts going down. Then the price goes back to the line. Let's zoom in to view details. After the sell, the profit amounted to approximately 70 to 80 points. We see one more return to this level, but the profits are lower, 30 to 40 points. The positions get fixed, and then a break happens. Then we see a small comeback for 20 to 25 points. The line has been broken. That means that there will be a rebound again and some movement inside the price channel that we've been working with. It reaches the resistance level quite quickly, and the participants see that it's necessary for them to sell. In this case, the profit was at the size of 60 to 65 points. The participants fixed their sales, and the market continued moving towards the resistance where a true break didn't make them wait. The line changes its status and becomes supporting. The price goes back and the participants start selling. Note that this time it reaches the line formed by the first peak after the break. A lot of people would take their profits here, therefore, there will be a delay. The market will be flat for a while. Next, the market would reach the support level again, and then they would start to purchase aiming at the resistance. The resistance level can be identified quite clearly here. The profits would be taken again. A deal made after a break leads to a beneficial effect again. This is how the work with the support and resistance lines is formed, which can change their status. Please note that the lines don't disappear, they go on working the same way. Therefore, when speaking of the longevity of the lines, there's often a question asked: how long should the lines be in use? The longer the level is formed, the more interesting it is for the market. It goes without saying that you shouldn't run to extremes and take the lines dating in the middle of the 70s when the market started its currency deals. You should be aware of that if a line is systematically broken, it doesn't mean that it's bad, because after a true break the participants see the rebounds and work off it. In this case, it happened twice. It means that the line is decent and it can be confidently used for trading. Here's the confirmation. We come to it again and we sold here. Then the line was broken. It changed its status again. Sales start after it becomes a support line. The movement continues, like in this case where we see the rebound. But the targets are not big. We don't reach the support level that we've been talking about. Firstly, the line has changed a bit. Secondly, even if the line is broken but it's strong on its own, there will always be a rebound from it. For a 1-hour chart, the rebound will be about 15 to 20 points. For a 4-hour chart, it will be bigger, 30, 40, 50 points. That is to say that there should always be a rebound of 40 to 50 points from a strong level, even if it's decided to be broken. Why is it so? Because the participants who have been buying start taking profits while reaching the line. Even if some people don't start selling, proceeding from some significant news or any other warning factors, there will be a number of traders who either wouldn't have got this information or wouldn't have considered it seriously For example, pre-election time in USA is a period of uncertainty. The dollar, as if must be falling. Someone forgets about the election and just sees the signal of the technical analysis that a sell must be started. That's what is done. Eventually, there are two important details. Firstly, the buyers take profits causing the downfall. Secondly, the sellers, even if there are few of them, would be moving the price of the resistance level. These are the factors that cause this small movement of the price. Usually it reaches the size of 30 to 50 points on a 4-hour chart. What is the conclusion? If we open positions off a resistance level, it doesn't mean that we'd have to sit for 3 days and wait for a maximum profit from the position. One of the options would be to close the position in a few hours for a profit of 30 to 40 points, as we can see here. The position here had been open for a bit longer. For example, if we opened at 1.2864, 3 candlesticks later, there was 40 points profit. We close the deal in 1 day and we are free to go. The following workday would offer new positions, but then we can sleep at night without nightmares or headaches because of the unclosed deal. Notes: a 15 to 25 point rebound is formed from any strong level on 1-hour chart. The rebound is 30 to 50 points on a 4-hour chart. Lesson 1. Technical Analysis. Period selection. At the moment we are looking at the dollar versus franc currency pair on the 1-hour chart. We can switch to the 4-hour chart and watch the price change in a different, much larger scale. The daily chart, the weekly chart, and so on. All in all, there are 9 different periods we can work with and build our technical analysis on. But which one would be better for us? They are all used for different purposes. There are a vast number of market players who have different goals and work with different deposits and different volumes. So, consequently, their goals would be different. 10 points for ones, 100 for others, and 1,000 for somebody else. And they are prepared to wait for these goals for a month, 12 or even 18 months. So, what period should we choose and how do we define it? Let's have a look at the 1-minute chart as an example. What does it show us? The price change takes place during 1 minute. A candlestick is formed in 60 seconds. Every 60 seconds, a new one appears. If we choose a different period, say 1 hour, then a candlestick would close every hour. A candlestick is formed during 1 hour. We have to consider the following. Based on the technical analysis, the maximum range for the price change forecast is the next 5 candlesticks. That's the maximum. If we have mastered the technical analysis, the maximum price change forecast period is the next 5 candlesticks. In our case of the 1-hour chart, the maximum forecast period, be it up or down, is 5 hours, since it takes 1 hour for a candlestick to form. Let's remember the average daily price fluctuation range in a currency market. For each currency pair, it varies from 40 to 240 points, give or take. On the basis of these figures and this average statistics, you can calculate the price movement range for the next 5 hours. The answer would be 9 to 50 points. Let's have a look at all periods, starting with the minimum, a 1-minute chart. If we use it for the technical analysis, for the forecast, for opening a position, then the goal would be reached within the next 5 minutes. But what goal would that be? What can we get in the next 5 minutes, keeping in mind that the average daily range is 40 to 240 points? That makes it 0 to 1 which means a profit of 1 point maximum. The 5-minute chart. Based on the average statistics, the figures here would be rather pitiful too, 1 to 2 points. Another period, the 15-minute chart. In this case, we are talking about 2 to 12 points range. If that's our goal, if we want to make 5 to 7 points, we can safely choose the 15-minute chart. But don't forget about the spread, which normally is 3, 5, 7, 10 points. So you will be simply working out the spread. What's the use of that? I can't see any. But if somebody is happy with it, they can work on the 15-minute chart and get a 1-2 points profit. The next period is M30. Here, a bar or a candle is formed within 30 minutes. The profit range is 4 to 25 points. Now, it's getting interesting. If our goal is 10, 15, 20, 25 points, we can work with the M30 chart. Let's look at the 1-hour chart. The range here is 9 to 50 points. The 4 hours chart. Having built the technical analysis on the 4 hours chart, we can expect the maximum of 200 points, the minimum being 33. So, from 33 to 200 points. The daily chart. We can find extensive information here that goes back to February 23rd, over 6 months ago. And the range for the next 5 days would be from 200 to 1000 points. Next come weekly and monthly periods, with a huge range. But in that case, you would have to wait for your profit just as long. Positions could stay open for months and even years. Let's look at the classical regular goals that traders would normally have. If we talk about the technical analysis, then one of the most significant is the 1-hour chart. They say that closing of 1-hour chart prices is determined by professionals. Let's take a specific situation. We open an M30 chart. The fluctuation range here is 4 to 25 points. These goals are rather low, and not everybody would even consider opening with that in mind. Most traders put a lot of effort, time, and knowledge into mastering the technical analysis to use it properly for work. Working with the technical analysis is almost an art when you can see everything, process it, and get a considerable profit as a result. Do you really want to get a 10 to 15 points profit, which amounts to $100, $150 for all that hard work? You can't master the technical analysis in just a day or two. You must spend weeks at the computer to get the hang of it, to sharpen your skills. We put efforts in it, we try our best, and all for 10 to 15 points. It's not really interesting, would you agree? Most traders set much higher goals for themselves. Let's go back to the 1-hour chart. The goals here are 9 to 50 points. That is much more interesting. What am I getting at? All the charts for less than 1 hour period are no good for the technical analysis. The reason is very simple. All self-respecting traders who have been in the currency market for some time and become its legitimate players, those who are actually moving prices. The prices get moved by the market players, and the trader is one of them. They get to the resistance level, they sell, and the price goes down. Anyway, traders use the 1-hour chart minimum. If you draw a support line on M30, other market players simply would not see it, as they work with a different period. So, keeping in mind that most of them look at the 1-hour chart, the technical analysis for M1, M5, M15, and M30 would be useless. The support and resistance lines would be systematically broken, which when working on rebound will cause losses. And that is not quite what we want. We have a different goal, gaining profit. Let me remind you of the rule I've already mentioned. Hour is closed by professionals. It's an interesting expression, and that means the minimum period for us would also be 1 hour. The goals here are rather good and rewarding, 9 to 50 points, and we are prepared to learn and spend a lot of time for it. Next, let's compare 1 hour and 4 hours charts, just to get an idea of what we see on one and on the other. Let's have the dollar versus franc currency pair on the left, the 1 hour chart, and let's have the same currency pair on the 4 hour chart. So what can we see? To make things easier, let's zoom out the 1 hour chart a little bit to give it more extension. So what happened? We can see basically two identical charts. The picture is the same, both on the 1 hour and the 4 hour chart. If we zoom in the 1 hour chart to the size we are working with, we'll just get a more detailed information, this particular part. We are looking at the recent effective changes. Based on that, we make our forecasts and aim at the nearest goals of 9 to 50 points. The situation on the 4 hour chart is much more interesting, more extensive, and if we open a deal here, the goals would be more attractive too, 33 to 200 points.